Welcome back to another market update. It is March, and there's a lot going on in the world, in the mortgage industry, and then therefore in real estate. We're going to talk about the great migration. It's not what you think it is. We've got the lowest interest rates we've seen in quite a while. We've got Trump buying some mortgage-backed securities. There's a lot happening. So we're going to dive right into the stats here in a second. I'm David Shapiro, my colleague Lee Abraham. We're a local Austin real estate team. So if you're thinking about buying or selling, go ahead and reach out to us. We'd love to chat with you. Remember, you can always find us back here at realestatevideohub.com. Brings us right back to our YouTube channel, where we have been posting these monthly for 4 years now, trying to keep you up to date in this ever-changing real estate market here in Austin. So here's what we're looking at for number of active listings. So we bottomed last month at 2,100 and a slight tick up here to 2,200. If you listen to our last video, we are expecting to see a continual increase into the spring here of the number of active listings.
Yeah, so starting the month with just over 2,200 active listings. And as we always do, we take a look at the velocity of sales. And we start with how many pending sales have there been in the last 30 days, and a significant jump. Over 834 to be exact, pending sales in the past 30 days. When you take that velocity and look at the 2,200 plus active listings, gives us under a 3-month housing inventory, David, 2.7 months. The other indicators, whether it be the 1-month average, 3-month average, closer to 4-month housing inventory, both of those figures are significantly below the 12-month average, where we're just under 700 sales a month, closer to a 3-month housing inventory. So regardless of how you parse out the digits, the market appears to be, even though it may not feel like it to some folks, more of a seller's market than a buyer's market. And we've seen some evidence of that with our clients, David. So yeah, we're looking for those pending sales to close, and then that's really where it's going to get interesting next month. See if there was a significant fall off, like there often is, between the pending sales falling out, and then how many actually close.
Yeah, this will lead to the great migration, which we'll get to here in a minute. So we got the 30-day monthly housing inventory over time. So similar to that first chart, but now we're taking into account the demand side of the equation as well. And you can see at 2.72 months, this is the lowest we've seen going back 2 years to last, so it would have been spring of 24. And so that's a good indication early in the season here. We do expect a lot more listings to hit the market soon, but anecdotally, on the buyer side, we have seen a good amount of buyer demand. Lots of people reaching out saying, hey, we're thinking about buying this year. And some people saying, hey, I walked into an open house. I wasn't expecting to be buying anytime soon, but I love this house, and now it's got me thinking. So if you're out there touring open houses, reach out to us ahead of time so we can talk strategy and put some plans into place. In case you like one, we're ready to move quickly, because the one I'm referencing was a multiple offer situation. It all happened really fast, which it can seemingly happen in real estate all the time, just like that. So, right. Lee, you want to talk about the number of sales?
Yeah, number of sales per month, down a little bit compared to February of last year. Had nowhere to go but up, David, versus last month's figures. So still not enough, but at least trending in the right direction month over month. The hope is that this really starts to jump up now, and I have a good feeling that it will. Will we get to over 1,000 sales a month this year? Last time that happened was what, May of 22, over 1,000. I'd like to see that this year. So anyway, we'll keep tracking it, but moving in the right direction. Just need to pick up the pace a little bit.
Yeah, I think there is a solid chance of that this spring, or this early summer, I would say. And this is just single family homes in the city of Austin. So just, be aware of that when you're looking at these numbers. If you're to look at this for the whole metro area, I hope that we're well over 1,000 every month. So, all right, let's talk about average sales price. So this is down 5% year over year. Last month, we talked about the anomaly in this number. And so I don't believe we even reported it last month because there was an anomaly in there that we had to account for. But it has been accounted for. And you can see in January, we're at 766,000, which is slightly down from the January before. Just like this month, we're down a little bit more from last February.
Yeah. So you mentioned the anomaly last month, David, and it was due to an agent incorrectly entering a sales price. I don't remember the particulars, but
It was
what
supposed to
was
be
it?
a $270,000 sale, and they entered it as a $27 million sale.
Yeah. So angling for a higher commission, no doubt, was the
Yeah.
motivation there. But it threw off the numbers. And so I've been doing this for a very long time. And I can't recall ever seeing one transaction, one error of data entry impacting a market wide metric like it did. And it jumped out at us. So we've had a ongoing debate over the years, not unique to us. It's common among the analytical circles of what's the value, what's the import, the relevance of average sale price versus median sale price. What do they mean? Which one do you rely on and why? And so in that particular case last month, the average sale price got thrown off by a significant amount of money. That's why it wasn't reported in our video last month, because we just didn't have the right number and didn't want to go out with incorrect numbers. So we just skipped it, knowing that it would be corrected. But we looked at the median sale price, and it was more in alignment with the historical data. And so that showed us that there was something wrong with the average, and David investigated it, found the particular sale. So we won't take a lot of time on this report, David, but why do we use average versus median? A lot of the national media, local media use the median sale price when they're talking about ups and downs. My position has always been that the median numbers are great when you're comparing it to the other median numbers for trend lines and things like that. It's helpful, it's useful, and it does reflect market trends. The difference to me between a median number and an average number is that the median number is basically a dead end statistic. You can't do a whole lot with it. The average sale price, you can multiply by number of units, get gross sales volume, and you can extrapolate that into different outcomes and different forecasts. So I've always been a champion for the average versus the median. You want to give a couple comments on the topic?
I think it is interesting when you're looking at the average because these larger sales in the luxury market impact that more. And that's why you see the average sale price here, look, it's hovering around 800K, whereas the median sale price is hovering, around 625 or something like that. So it emphasizes how big our luxury market is in pulling this average up above the median.
Right. And that's definitely one way to look at it. The other element is just, as human nature, people think in averages, not medians. When folks are talking about how their kid's doing in school, he's median for his age group, or above median or whatever. It's just so. Anyway, I have a bias that I'm airing now here, but I will
Yeah.
say that I did find the median useful last month, David, on helping us
Mhm.
confirm that there was some bad numbers in the average calculation.
Yeah, I mean, I like your point about you can do something with it. Like people know how to calculate the average. They do it all the time. They took a bunch of numbers, they divide by how many there were, right? The median, people aren't generally, counting their way in to figure that out as, in layman's normal stuff. So it's used only in these types of things. So it could go either way. And we have this discussion, like you said, people in the comments will often say, "Hey, what about the median?" All right, the Great Migration. So this is what I've been talking about probably for 2 years now, and I wanted to show a visualization here on the map so you can see what I'm looking at. We had a discussion before this, Lee. Is it just because of my demographic? I feels like I have a friend have a kid every month at this point, and I don't think that's even an exaggeration. If we were to take the average number of kids that my friends have had over the last 12 months, it would be one a month. And so with that in mind, a lot of those people are thinking, hey, I started off by living on the east side. Maybe I'm living off of Montopolis or in South Austin. And they're thinking, okay, I now have a kid that's going to be going to school soon. And if you look here, these are all the schools. You can see the little gray, I don't know if it's gray or black. These dots are all the schools. And when I select the filter, and I did $750,000 up just because that is generally what our demographic is looking at in terms of home prices, is that's like the lower end. And then we go up from there. Well, if I go on and put an 8+ score for great schools, look at all those schools that just disappear off the map. And then the green dots are the homes for sale in those school districts. So one thing you'll notice over here, people living in Zilker and Barton Hills might say, but wait, we have a great elementary school, which you do. And the way I set this up is you had to have an 8+ score for every school, your elementary, your middle, and your high school. And so unfortunately, Austin High did not hit that, where these guys go to high school. So, some of these areas, if we were to do this differently, would look a little bit more like this, where you do have homes for sale and those schools do meet that requirement. But you can see where people need to be thinking about. They need to be going to Mueller. If they're on the east side, they're moving to Mueller. Up here to Central Austin, where it goes to McCallum High School. Over here in Steiner, in these areas, they go to Vandergrift High School, which is also a well-rated school. And then, of course, the golden school of not only the Central Texas, but I would say of Texas, it's one of the best school districts in the state, is the Ean School District, which you have over here, which elementary through high school at Westlake High are all rated above 8. And then this little battleground down here, Circle C. And I mentioned that because we were just in a multiple offer situation in Circle C for this exact scenario. A friend who wanted to move into a better school district. They really like the balance here in terms of price. There's really nothing selling for over 1.3 million in Circle C. So in terms of proximity to downtown, schools, these are really highly rated schools. There's a lot of value in Circle C. And I think this is going to be an area that is really sought after here over the course of the next couple of years. And there's only a couple listings available right now. And the ones that are updated and have all the nice features that buyers are looking for, they're going quick. There's 5 offers on that home. And so you can see where people are going to have to be trending when they're thinking about school districts. And this is what I'm calling the great migration from these areas here over west into the better school districts. Lee, thoughts on that?
No, I think it's a astute observation, and haven't really looked at the numbers in terms of the composition demographics of buyers. But certainly in our experience, our client base and the transactions we've been involved with, it's holding true, is that the move to the better school district is motivating lots of folks that are making in-town moves, David. So I like it. The other thing that I would say is that typically, the better schools, they don't always come in the areas that have the lowest tax rate. And so if you're a buyer who's tax rate sensitive, one thing to consider is, pay me now or pay me later. And if you're in a district that has got great schools, you're likely going to have better appreciation, which will likely more than offset a tax differential. Just something to think about. But I like it. And for folks thinking ahead, it's something for us to consider, which is something we do with each buyer that we work with.
Yeah, and to that point, Lee, my philosophy that we've mentioned on here many times is that the best neighborhoods appreciate the most, and they hold up the best they appreciate the most in the good times, and they hold up the best in the bad times. Mm-hmm. And that, I think, has been very evident over the last 3 years, because you see parents where if they don't have kids in school, if somebody, they don't even have to be parents. Somebody that doesn't have kids in school, they're totally waiting this out. They're with their 3.5% mortgage. They're not going to move. But if they have kids and they're going to school and they want the best for their kids, which I'd say all parents do, they're willing to bite the bullet and make the jump from a 3.5% to a 5.5% or 6%, whatever their mortgage rate would be, doubling their costs on this new home because it's for their kids. And so that's why we've seen more activity and prices hold up a little bit better in these areas with the better schools. So keep that in mind, whether you're an investor or you're just somebody that, live in the home for 5 years and then resell it. I bought a duplex in Eanes 10 years ago, knowing that, hey, it's a great school district and I'd like to have something in there. All right, moving on. We've got days to sell. Lee, anything to see here?
Just that the trend is moving in the right direction. We were looking for that 80 days to drop. It did. It's pretty much in alignment with the past few years. So this should be dropping steadily, David. And yeah, it looks good for where we're at right now.
Number of new listings up 23% from last month, down a little bit from last year. Again, trend we probably were expecting to see. Nothing out of the ordinary here.
Yeah, well, look at the number. If you go back, look at the number last year for the month of March. The next, March, April, May. It'll be very telling to see where the numbers come in for us now in 26. Again, I don't know if we would actually get over, that 1700 mark, but that's what I'm looking for a balanced market. If we can get a good supply of quality listings on the market, pent up demand starting to make its way to the market with rates trending down, we could have a real blockbuster second and third quarter here.
I want to emphasize the quality homes hitting the market, quality listings. That I think the months of housing inventory can be a little bit misleading in the days on market because you have some stale listings that have been on the market a long time that clearly are either overpriced, have some sort of deficiency, like maybe they back up to a highway or they don't really have a backyard, things like that that would just deter certain buyers. And the good homes, those are ones that are selling quickly and right at market value. So if you've been in the market and if you've watched any of our videos, it's hyper local. And so if you're thinking about buying or selling, you really should talk to a professional, reach out to us. We'd be happy to chat with you and look at your hyper local market dynamics. And for those of you that are watching and you've been in a certain neighborhood you've been watching or you live in and you've seen a lot of activity, I'd love for you to comment below which neighborhoods are seeing a lot of activity. And if yours is slow, you can also comment that. All right, sales price to list price ratio. This was actually one of the ones that was thrown off significantly by the $27 million sale. But we fixed it manually last month. But here, if you want to go over it, Lee.
Yeah, and the math that you came up with was good. And so
Was it? I didn't double check. So
we went live last time for January at 96%, and you were only off by 0.05. So to me, that's good as gold. 97, again, trending in the right direction. I'm looking for this to continue to go up, David. That would be in alignment with everything else we're looking for in a strong couple quarters coming up.
Yeah, and I'll do a quick summary at the end of, hey, if you're a buyer and if you're a seller, what does this mean for you? So we'll wrap it up with that, everybody, because there's a lot of data points and you might want to just cut to the chase of what's the TLDR. So I'll give that to you at the end. Okay, our inventory barometer. This is a real-time stat that Lee put together because a lot of the stats here are lagging indicators. This is a leading indicator. So Lee, why don't you, here, I'll just point this out. Originally we're looking at this 100% line. So that's the number we're looking at. And here you can see the number of new listings, the number of pending sales, and the percentage. What else do you want to tell us about here, Lee?
Well, I mean, if you just look at the columns there, the new listings, 267, 261, 273, 276. So you can see that even though it didn't aggregate necessarily in a impressive jump, it showed, an increase. And this is really week over week showing us that there is some supply coming to the market. The demand has also picked up. And, as long as we're over 100 and under 200 right now, the numbers are going to sort themselves out. So the real key, David, is if we go to the next slide, which shows us the impact of the expireds and withdrawals. So, over the past year or two, even, these expired and withdrawals have really been saving the equity positions by keeping the number of active listings down and keeping us from an oversupply or glut. Those are all the weeks that are highlighted in yellow, where after you took into account the expires and withdrawals, there were actually fewer listings at the end of the week than there were at the beginning of the week. Well, that was not the case over the past 4 weeks. We've had a true net increase in the listing inventory. And so, because the monthly housing inventory is so low, as we showed earlier, this to me is very healthy. More choices, brings more buyers to the market, and it's a very good sign. I'd like to see this continuing to go up over the next few months.
I've seen a lot of these withdrawn listings going to, where agents are keeping them as pocket listings and they're either sending email blasts out to other agents or there's some, forums for agents where these get posted. And so it's interesting to see them. They'll pull them off for 90 days, which is what it
Right.
takes to reset the number of days on market. And they'll usually, do that towards the end of the year, knowing the holidays is slow. So a lot of these are going to be coming back on the market fresh as new listings, even though they were previously on the market. And we looked at one with a client. It had been on the market last year and almost, nearly $3 million. And they came back on the market a couple of weeks ago at nearly $3 million. And they're sitting, that one particularly. So it's all about pricing it right. That home got a lot of interest, but you have to price your home right. We see this all the time as ownership bias. And if you're not familiar with this concept, it's just that you think your thing is better than other people perceive it. And people do it with their homes all the time. I'm even a victim to this. We tried to list one of my homes like 2 years ago, and Lee told me how much it was worth. And I was like, no, it's worth more than that. So it's really hard. And it takes somebody, Lee's really good at being objective about these things and coming in and, he has had to deliver some bad news in the last 2 years.
Yeah.
People, aren't getting exactly what they thought they would get, but we want to be realistic with people. We're not going to tell them something just because they want to hear it.
Right. Yeah. And sometimes pricing is a little abstract and there's always a range, but,
Yeah, always a range. Yep. I
yeah.
learned that lesson early on in my career. I would pick an exact number. I'd be like, this is it. I'm not paid over this. And, that didn't work because it's a range. All right. This is once you take into account the withdrawn listings, you can see it's kind of a nice oscillation here. Sometimes we're adding inventory, sometimes we're losing, but it's kept us with a pretty good balance. And I think the key thing to look at here is we're right about, this is last year, early March right here. So this is where we're going to start to see inventory builds from this point going into, this means it was building all the way through the end of June where it started to go drop a little bit. So
You want to do a
what that means for
spoiler alert?
buyers,
You want to do a spoiler alert for sellers? Now's the
sure,
time,
go for
right?
it. Yeah. Yeah. So the TLDR is if you're selling, you want to be on the market now. If you're getting advice that you need to wait, if anything, what's today? Wednesday. Tomorrow is probably the ideal day you could lease because I saw on my tree right here, I saw green blooms. And we're at the lowest inventory where you have the green starting to pop on the trees. And so I would not wait if you're trying to sell your home being strategic. Of course, if you have to prep it and all that, but we can usually get stuff listed in about a week. So if you're thinking about it, reach out to us. We'd rather have more time so we're not rushing and we can make sure everything gets done correctly. And then buyers, you don't need to rush into anything right now. You can wait. If you find something you love, you should jump on it. If it's the right price, it has everything you want, then jump on it because I think those types of homes are going to go really fast and you don't want to wait until more buyers are in the market competing. But if you don't love it and it's just okay, I think it's okay to just wait and see what else comes up over the coming months.
Correct. So
All
this is
right.
this is just showing the information a little differently, David. Um, the key to it really now, with the red being the pending sales and the new listings in the blue, we're looking for these lines to trend in more of a lockstep than a divergence. And that's what'll keep our market stable. In other words, if there are a lot more new listings hitting the market and then a lot of buyers entering the market to absorb those listings, that's going to be good for everybody. What you don't want to see is the trend lines moving in divergent directions with the listings going up, the sales going down. And the good news is that is not our forecast. So I like what I see so far.
Yeah, this chart makes me feel like we're fortune tellers, that we like really have been nailing this, because these two are moving in the same direction as we said would happen, something like back here, and then there will be some air between them as new listings outpace pending sales. Not to an extent where it's causing it to be a really strong buyer's market. It's going to stay balanced. If not, some areas it's going to still feel like a seller's market. And so I think, this is the prediction I feel the most confident in here. All right. Mortgage rates. This is the mover. This is what people have been waiting for. And what do we see? Look at that. We are at the lowest rate in the last 52 weeks.
That's the first time we've been under 6 in a very long time.
Yeah, that's awesome. Good to see. So you can see the story, that we've been portraying here, more pieces to it that show that we're going to have a pretty solid 2026 in our opinion. All right, on this chart, on this article, a huge portion of people that are considering buying are waiting for mortgage rates to fall below 6%. And we just hit that magic number. So again, I think we're looking good for this year. This is one you found, Lee.
Yeah, so I mean, as we try to help folks understand what the heck's going on in the real estate market, we always hear about supply and demand, employment rates, cost of living, all of these different variables that go into that supply demand dynamic. And from time to time throughout the course of history, the federal government gets involved on manipulating the market a little bit. Back when I was in college, it was Ronald Reagan and the Accelerated Cost Recovery Act, where they shortened the depreciation schedule on commercial property, which increased the tax shelter per year for the owners and created more value in the commercial market. That was huge back then. Now we have a $200 billion allocation to essentially slash mortgage rates, David. So the idea is that purchasing securities that are mortgage backed creates more demand, and that has the inverse relationship on the interest rates. So it's just fascinating to our buyers and sellers. What it means is that it's not just the organic forces interacting, there's an agenda to lower interest rates, and that the federal government is doing everything they can to manifest that agenda. So if you're banking on lower interest rates, this is in alignment with you taking action this year. And so the next slide, I think, kind of bears this out. This was just this morning, so I was putting the slides together. And wow, what do you know? Mortgage demand's up 11% over the past week. So again, it's in alignment with our forecast, David, for a very strong second and third quarter here in the Austin market.
Yeah, and if we were to start to speculate even more, there's a lot of talk about AI, Square, now called Block. If you're familiar with Cash App, they cut 40% of their workforce, 4,000 people. I think from my read on it is they might have just had too many people. They had hired too aggressively. But, people do talk about AI taking jobs. It will be curious if that does start to happen, if the Fed starts to lower rates more because they have this dual mandate and they need to keep employment high. And so would they maybe lower rates? Would there be downward pressure on rates and upward pressure on housing, similar to what happened during the COVID spike, where they had to lower rates really quickly to try to stimulate the economy? And so some sort of a recession or, pinch on jobs could be good for mortgages, and therefore for homeowners and, buyers getting lower rates, increasing the activity there. Of course, you can take that to its conclusion and say, well, what if they lay off everybody because of AI? Then the whole thing's going to collapse. Yeah, well, then we got a lot bigger problems. So I think, from my experience, these things tend to go in waves of tightening and loosening monetary policy, and we're certainly going into the loosening portion of that cyclical thing. All right, you can always find us back here. Again, there are infos below. If you want to, call us, text us, whatever about something you got going on in your world with real estate, we'd love to chat with you, talk about your specific goals and needs and how we can get you there. So thanks for joining us. If you like this, please share it with a friend.
Thanks, everybody.